We're going to assumptions for the balance sheet assets in particular. We got cash and cash equivalents as the top item. Here's the historicals, and we can see, relative to their assets, they carry fairly large cash balances. That could be for any number of reasons, probably very likely related to future acquisitions, or be able to move quickly in that regard. Let's just look at assumptions here, and we can talk about them for this. So we're going to have treat cash as a plug, that is to help us balance. We'll talk about that in class. And also minimum percentage of sales. And I've got 21%, and that's based on the historicals. So over here to the right, we can see the percentages, and we're kind of going something pretty close to the average and the median there, 21%. Now for accounts receivable, so that's accounts receivable, as you know, is money's due from customers, and we'll do that one in class. So I'm going to jump down to inventories or inventory, and as we might expect, or again we should ask ourselves, should that be related to sales or not? And it should be. And we'll actually, however, tie it to cost of goods sold. So it's more commonly we look at inventory as a percentage of cost of goods sold, or cost of sales in this case. So let's move over a bit, and here I've done some calculations. That is inventory as a percentage of cost of goods sold, and you can see the little formula right there for that. And fairly steady over time. There's the average 20.6. Median's pretty close to that, so we'll go with 20.35, which is actually the median, and also the last year for that. We're doing prepaid expenses in class, so I'll skip over that. Property, plant, and equipment. So let's see additional assumptions, and we're actually going to jump over to the pro forma here in terms of looking at those additional assumptions. So we need to think about what drives property, plant, and equipment. Would it be related to last year's figure? It sure would be. These are fixed assets that are depreciated over time and may be added to, of course. So let's go down to the additional assumptions. And here we are for the PP&E. Okay, so in general, property, plant, and equipment, we would take last year's figure, subtract out depreciation, add any capital expenditures. Capital expenditures, that's money spent on new property, plant, and equipment in that given year. Again, so we'd add that, and we subtract any sales of PP&E, that is the book value of those assets that are sold. So you can see here we're making assumptions about these three things. Depreciation, we're going to look at as percentage of prior year PP&E. Capital expenditures as a percentage of sales at 3%, and then the sales of used equipment, we're going to treat that fixed at 0. Usually that's fairly small, so we're going to treat that as 0. Now, where did these percentages come from? Well, let's go back to the other worksheet. Let's look at the capital expenditures. Go back to historicals, and I'm down here, row 149, and here are the historicals on capital expenditures. That came from the cash flow statement. Actually, you can see that equals C89, and we'll look at that as percentage of sales. So here, taking that as percentage of sales, and you can see, pretty close to 3% each year, particularly for the last 2 years. That's where we're getting the capital expenditures. Depreciation. Here's the historicals again off of the cash flow statement, and our assumption, as you saw on the previous page, we're going to do a percentage of PP&E prior year at 47%. Why 47%? Well, here I've taken the depreciation and divided by the prior year PP&E, and so we're looking at pretty close to an average there of 47%. So we'll stick with that 47 as a benchmark for that. And then finally, for the assets sold, we're assuming that's fixed at 0. kind of validate that. Let's back into the assets sold, noting that down here, PP&E net plus capital expenditures as is prior year plus capital expenditures minus depreciation minus assets sold would equal this end of year figure. We want to solve for assets sold, so we would add it to both sides. Okay, we add it to both sides, and then would subtract the PP&E net end of year. So we end up with prior year plus capital expenditures minus depreciation minus the PP&E net. So let's see if we can do that right quick. So equal prior year plus capital expenditures, subtract out depreciation, subtract out the PP&E net. Again, to back into assets sold, and we'll do a quick check. So computing our 236, we would take the beginning of year, add capital expenditures, subtract out depreciation, subtract out the assets sold figure we just got, and we see those do match. And I'll just turn this into a logical test. So put parentheses around that and ask, does that equal 236? And it is true. So we'll drag this across, and we'll drag this across. Okay, so that's just to verify that we've calculated this asset sold correctly. So we can see this for the last 4 years, and relatively small numbers in the scheme of things compared to other figures. So we're going to, that's why we want to assume that this is fixed at 0, because it is very difficult to predict what this might be going forward. That's our explanation for what we're doing here with PP&E net. Next we have goodwill. We can see the historical amounts here. And the first question is goodwill related to percentage of sales. In general, no, goodwill arises from acquisitions. So when a firm acquires another company, or in this case Hasbro, and they pay over quote unquote the fair value of the assets for that company, it flows into or becomes a part of goodwill. And so we can see here that it has tended to be pretty steady the last little bit. And here's what we're going to assume. Actually, we're going to assume that it's fixed. I did a little bit of searching in terms of the 10K to see if there was a discussion of upcoming acquisition. So if they did have upcoming acquisition, they might have talked about impact on goodwill. I didn't see any discussion of that. The other thing that could impact or would impact goodwill from period to period would be a write-down or impairment. They did have a write-down between or in 2016. That's why we see this decrease here. So there's no reason to expect another impairment charge based on reading the 10K. So we're going to go fixed with the prior year. So again, what would drive the future number would be future acquisitions as well as impairments of the existing. We don't see either one of those clearly occurring in the future, so we'll leave it fixed at that value, the prior year. Other intangibles net, that is net of amortization, that would be copyrights, patents, those type of things. And in terms of our assumptions, we're going to see additional assumptions. So we're actually going to calculate that as follows. Move over to the pro forma worksheet. So again, see additional assumptions, and the additional assumptions are down here below. So here's our other intangibles net. We're going to assume that amortization comes from the 10K. That's based on the existing intangibles. We've already been actually through this when we worked on the income statement. That new other intangibles are assumed to be 0. That is, purchases, acquisitions of new intangible assets, we're going to assume are 0, and sales are also 0. So given that, we can then compute the forecast. So it's basically going to be the prior year minus the amortization. And we'll also include these, you'll see in the formulas. So you can go back and look at the discussion from the income statement about how we came up with these numbers. And we'll look at the other assets, going back to historicals here, worksheet that is, and we can see the dollar values, again, those are in thousands. We're going to assume that it's a percentage of sales at 15.54, but this one we could certainly do different things with. Here we can see it as a percentage of sales, and I'm actually just using the last year that we have. There's the average and the median, and again, arguably, maybe we should use 16.5 or even a fixed amount, even though it is kind of going up. So I would tend to have it going up at least some. So we'll settle on this, but certainly could make other assumptions about the other assets, that is, other assumptions than what I have here.